Successful investing doesn't require a super high IQ, insider tips, or luck. Instead, you need a clear way of making decisions and the ability to keep your emotions in check. In The Intelligent Investor, Benjamin Graham offers a solid decision-making process and advice on controlling emotions. His investing strategies has been one of the most successful over the past century. The success stories, not just of Graham, but also of many who followed his teachings, are hard to ignore. The most famous of these is Warren Buffett, who, at the time of this video, is the 6th richest person in the world. Warren Buffett calls this book the best book on investing ever written. In this video, I will share what I believe are the most important lessons from the book. Takeaway number 1. Meet Mr. Market. Imagine you own a part of a business that you bought for $1,000. Every day, a man named Mr. Market comes to your door with a new opinion on how much your share is worth. He offers to either buy your share from you or sell you more based on his changing opinion. But here is the thing, Mr. Market's opinion is often wrong. For example, in March 2000, he thought your share was worth $2,600, but by March 2001, he believed it was only worth $500, even though the company's income and the profit had actually increased during that time. Should you let Mr. Market decide the value of your investment? Definitely not. Benjamin Graham's key idea is that a stock market represents a piece of a business, not just a price tag. Since Mr. Market can be overly emotional, sometimes too excited and other times too fearful, the actual value of the business can be very different from the price he is willing to pay. Graham suggests that you should only invest in a stock if you would be comfortable holding it for the long term without worrying about the daily price changes Mr. Market offers. If you stay patient, you can use Mr. Market to your advantage. Sell when he offers a high price and buy when he offers a bargain. Back in 1970s, when Graham wrote The Intelligent Investor, Mr. Market might have shown up once a day with the morning newspaper. But today, Mr. Market appears every time you check your phone, possibly over 100 times a day. However, just because Mr. Market is more persistent now, doesn't mean you have to trade with him more often. If his offers doesn't meet your standards, simply ignore him and carry on with your day. Takeaway number 2. How to invest as a defensive investor. Graham identifies 2 types of investors: the defensive or passive investor and the enterprising or active investor. Most people are better suited for the defensive strategy because it requires less time and effort. If you fall into this category, here is what you should do. 1. Create a balanced portfolio. Mix your investments between stock and bonds, possibly with a 50-50 split. Adjust this balance based on your life situation and the returns of stocks versus bonds. 2. Rebalance annually. Once or twice a year, check your portfolio. If one type of investment grows too much compared to the other, sell some and buy the other to restore balance. For example, if stocks grow to 60% of your portfolio, sell some stocks and buy bonds to return a 50-50 split. 3. Regular investments. Invest a fixed amount of money regularly, like after each paycheck. This strategy, called dollar cost averaging, helps you buy stocks and bonds at various prices, which can lower your overall cost. For the stock portion of your portfolio, follow these 8 guidelines. 1. Diversify. Invest in 10 to 30 different companies across various industries to reduce risk. 2. Choose large companies. Invest in companies with annual sales of at least $700 million adjusted for today's value for more stability. 3. Check financial health. Ensure the company's current assets are at least double its current liabilities. 4. Look for consistent dividends. The company should have paid dividends for at least 20 years. 5. Avoid recent losses. The company should not have reported any losses in the past 10 years. 6. Check for growth. The company's earnings should have grown by at least 33% over the last 10 years. 7. Don't overpay for assets. The stock price should not exceed 1.5 times its net asset value. 8. Don't overpay for earnings. Ensure the price to earnings ratio is 15 or less. If you would rather not spend too much time managing investments, consider investing in an index fund, which provides returns similar to the market average. If you're satisfied with average returns, these basic guidelines are sufficient. However, if you're aiming for the higher returns, you will need to explore more advanced strategies. Takeaway number 3. How to invest as an enterprising investor. Being an enterprising investor isn't as easy as it sounds. It requires patience, discipline, a strong desire to learn, and a lot of time. Many professionals and private investors struggle with this. During the dot-com bubble in the early 2000s, some experts made statements like, "It's a new world order, and higher prices don't make the market riskier." These turned out to be costly mistakes. The reality is, price is crucial for enterprising investors. The market often overvalues fast-growing or popular companies and undervalues those with poor performance. Enterprising investors should avoid growth stocks because they rely too much on uncertain future earnings. Instead, look for the companies valued below their net working capital, where you are essentially getting fixed assets for free. These opportunities are rare but can be very profitable, especially during tough markets. Graham also offers a method for finding investments that have looser criteria than those for defensive investors. Enterprising investors should analyze a company's financial reports and apply some diversification, but there is no strict rule on how many companies to hold. Takeaway number 4. Insist on a margin of safety. No matter how carefully you analyze an investment, there is always a risk of being wrong. To reduce this risk, always invest with a margin of safety. This means buying a stock when its price is significantly lower than its calculated value. Ideally, no more than 2/3 of its value. For example, don't invest in a stock you think is worth $31 if it's priced at $30. If your calculation is wrong, you could lose money. When you find an investment with a good margin of safety, be prepared to hold it for the long term. Don't worry about short-term price fluctuations. Instead, focus on whether the company's value remains solid. If the company's value drops due to a mistake in your analysis or new, critical information, consider selling quickly to avoid further losses. Takeaway number 5. Don't let others' opinions influence your decisions. With so much information available today, it's easy to be swayed by others' opinions. However, as an investor, you must stick to your own analysis and decisions. The market will often tempt you with opportunities to buy or sell, but unless new information changes your original analysis, stay the course. Remember, the biggest challenge an investor faces is often themselves, not the market. Thank you for watching till the end, and if you haven't watched our previous video, then make sure to watch it. And also comment down below which book summary you want to watch next.